Hello. In this video, we'll be going over the amortization of intangible assets. There are two classifications for intangible assets. There's what's called the finite life, and there's indefinite life, which we'll get to at the end of this recording. And finite life means there's a determined useful life for that intangible asset. An intangible asset is a long-term asset that is capitalized on the balance sheet, and these are assets that you cannot physically touch. So this might be a patent, a copyright, trademark, goodwill. There's various franchise fees. There's various intangible assets that are capitalized on the balance sheet. Let's talk about, and so once those are capitalized, we have to allocate those costs into the income statement through amortization expense. So let's talk about the useful life of intangible assets. How do you determine what the useful life is? Well, it could be a legal, regulatory, or contractual provisions that are set in a, they're preset, and that's what you have to amortize the asset over that life. Or sometimes it might be less than the asset's legal contractual life because other factors are known that would reduce that number of years. When we amortize intangible assets, we're going to take the cost minus residual value divided by the useful life. So the residual value is expected to be zero, usually is zero. And the residual value is not zero only if at the end of its useful life to the reporting entity, the asset will benefit another entity. And the allocation method is through the use of amortization and should reflect, the best use of the pattern of use of the asset in generating the benefits. Let's go through an example. International Diners Corporation, IDC, began operations in 2027. Early in January, the company purchased the following two intangible assets. Number one is a franchise from Ajax Industries for $200,000, and the franchise agreement is for a period of 10 years. That's going to be our useful life for this intangible. Number two, they also acquired a patent for $50,000. The remaining legal life of the patent is 13 years. However, due to expected technological obsolescence, the company estimates that the useful life of the patent is only 8 years. So if they expect it only to be useful for 8 years, even though the remaining legal life is 13, we're going to amortize it only over the 8 years. And it tells us that the company uses a straight line amortization method for all intangible assets, which means that the calculation is going to be the cost minus residual value, which there's none here, divided by the useful life. That's the calculation. Will give you the amortization expense per year. So let's do the first asset, the franchise fees from Ajax. You take the $200,000, divide by 10, and that gives you $20,000 of amortization per year for the next 10 years. And so for the next 10 years, they record this entry, debit amortization expense, to go on the income statement for $20,000. And similar to the depletion of natural resources, we do not use an accumulated amortization account, which would be a contra asset account to the intangible. You can, a company is allowed to, but typically they just credit the actual intangible asset, which in this case is the franchise. So credit $20,000. The second, the patent for the $50,000 patent, we're going to take the $50,000 divided by 8 years, gives us $6,250, and we're going to do debit amortization expense for that amount and credit that patent itself. Now, it tells us the IDC decided to sell the patent, okay, so they're going to sell this patent on December 31, 2031, 5 years after acquisition for $21,000. IDC had recorded annual amortization each of the 4 prior periods yeah, they just record the amortization expense. So let's look at that. So each of the 4 prior periods, right, they recorded amortization expense for $6,250, right, from 2027 to 2030. So when you sell a patent, the first step is you have to record the amortization expense through the date of the intangible sale. So in this situation, since they sold at the end of 2031, we have to record amortization expense for the full year. So it's $6,250. Now, let's record the actual sale. So they sold it for $21,000, right? That's what we're told right here. So we're going to debit cash $21,000. And we have to write this pen that's on our balance sheet. You guys know I love to use T accounts. So when we acquired the patent, right, we acquired it for $50,000. So in 2027, we debited $50,000. And then each for the next 5 years, we credited the amortization on that patent, which was, let's see, $6,250. So $6,250 in 2027, 28, 29, 30, and 31. So we had $6,250 that we credited, 6250 for the 5 years, and that gave, if you take the 50,000 minus all these amortization expenses, you get a debit balance of 18,750. And so now we have on our books a debit for patent asset for 18,750 that we need to write off because we sold it. So here we go. That's how we get this patent account balance. So we're going to credit 18,750. So when we credit the 18,750, then our account will be 0. And then we have to, that journal entry does not balance. So we have to record a gain on the sale of the patent for the difference, which is 2,250. And that's really the selling price was 21,000 minus the book value of 18,750. So that's how we record the sale of the patent. Let's talk about software development costs. Software development costs are costs that are incurred to develop software for companies. And really quick, when we start actually, testing to see if this is even possible, then all those expenses up to the point where a company reaches technological feasibility, which is a subjective term, but they determine that now we think this software is actually feasible. Up to that point, you expense all costs incurred with that development as research and development. From the point of technological feasibility until the point that the product is actually released, any costs incurred in here, those are costs that are capitalized as intangible assets called software development costs. And then once the product is released, then that's it. There's no more cost to be capitalized. But these costs are capitalized in this time period. They're capitalized and amortized. So there's 2 methods to calculate the software development cost, and you have to calculate both methods to see what your amortization expense will be. And whichever one is greater is the amortization expense that you will take on your income statement. The straight line method we're very familiar is the cost minus residual value, if any, divided by the number of useful life, number of years or months, whatever that period is, number of years of useful life. The percentage of revenue method takes because once we start amortizing once the product is available for release to customers. So we take the current revenue divided by the current revenue, right? Plus the expected revenue over the lifetime of the software. Expected lifetime revenue. So you calculate, and that'll give you a percentage, and you apply that, you multiply your times your capitalized cost to get to your amortization expense. And once you compare this amortization expense to the straight line method amortization expense, and you take the greater of the two. So let's go through this example. The Astro Corporation develops software graphics programs for sale. A new development project started in 2026 and reached the point of technological feasibility on June 30th, 2027. The costs in 2027 were as follows. Prior to June 30th, they incurred $1.2 million. And then from June 30th to December 31st, they incurred $800,000. Starting January 1, 2028, the software was available for sale. And here's the sales information. They had sales of $3 million in 2028. And then they estimate that for the next 4 years, the next 3 years thereafter, they'll have sales of 7 million to give them total estimated sales over the 4-year life of this software of $10 million. And it says, okay, number one, determine expensed versus capitalized account amounts in 2027. Well, anything that was incurred prior to technological feasibility is expensed as research and development. So that's going to be $1.2 million. And then everything from the point of technological feasibility through product availability for sale, I'll say, is going to be a capitalized cost as an intangible asset on your balance sheet. So then, okay, let's go in and calculate our amortization expense that we're going to take for our first year, which is 2028. So first you have to calculate the percentage of revenue method, which will take the current revenue. So this is for 2028. Okay, this is what we're doing for the whole year 2028. You're going to take the current revenues of 3 million divided by the total lifetime revenues expected to be generated from the software, which we were told is the current the 2028 revenue plus the next 3 years we expect 7 million, gives us a 30% percentage of revenue, and we multiply that by the capitalized cost. So these are the costs that we incurred between 7/1/27 to 12/31, right? That was after technological feasibility, before the product was available for sale, and we get $240,000. We also have to calculate the straight line method, which was 800,000. This is kind of weird. I don't know what this U is, but this, yeah. So we're going to take our capitalized costs, and we think that there's a 4-year useful life for the software, and that gives us $200,000 per year. We compare 200,000 versus 240, and the 240,000 is greater, and so that's the amount that is going to be recorded on the balance sheet as not on the balance sheet. That's the amount that's going to be recorded as a journal entry. Debit amortization expense 240. Credit software development costs, right? Directly we're going to credit the asset for $240,000. I mentioned earlier in the video that intangible assets fall into 2 categories, one that have a definite life and the second one here is indefinite life. And an indefinite life is when an intangible asset is determined to have the useful life is considered to be indefinite because there is no foreseeable limit on the period of time over which the asset is expected to contribute to cash flows of the entity. So these are assets that can provide benefit and cash flows for an infinite amount of time. We don't know. We can't put a number on it. And those are considered indefinite life intangible assets. Examples of those are goodwill, trademarks, and trade names. These intangible assets, the goodwill, trademark, and trade names, would be acquired assets. So if, let's just pretend, okay, that Nike acquired Adidas. I don't know if I'm spelling that right, but Adidas. 1D, 2Ds, I don't know. And so then they capitalize the trademark, you know, those three little lines that Adidas has on all their shoes and stuff. They acquire that trademark and they capitalize it. What's the useful life of that? It's indefinite. We don't know. As long as it keeps generating revenue, then it still works as an intangible asset. And so those costs are capitalized to the balance sheet, but we don't amortize them. However, indefinite useful lives are subject to impairment. So they have to be examined to see if the value of those trademarks, goodwill should be written down. And that's covered in a couple of other videos.